Welcome to Stock Watch with me and Auleng Lechela. And joining me to unpack your stock-related questions this evening are Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thank you so much for your time this evening. Let's start by reflecting on some of the earnings that were out today. Kicking things off with the Gucci owner Kering. Those numbers don't look good, right? With the moneymaker, Gucci's sales down 10%, but it seems like markets are shrugging that off. The last time I checked, Kering's share price was up 11%. Were the results not bad as expected? Was the bad news already priced in? Or was it more a case around maybe an improving outlook for FY 2026, Ricus?
I think there's a couple of things in the luxury sector that's happened over the past number of weeks. We've had a number of names reporting, and they weren't great, but they weren't that bad either. Then they got hit by the whole Greenland thing, and Trump saying he's going to impose further tariffs on Europe, and that's obviously still knocked that sector because a lot of their export is into the US. The sector has recovered somewhat, and I think with Kering, we're also seeing that, if you just take a look at American consumer spend that was reported a little bit earlier in the US, your sort of man in the street is spending less on stuff. But if you have income, if you have a decent income and assets, that part of the consumer market actually ticked up. So there still is demand coming through, and we're also sitting in pretty uncertain markets, and luxury remains pretty defensive in that respect.
Your thoughts around that, JP? Ricus touching on the macro issues weighing on the luxury market, and I'm wondering how much, I guess, maybe the second-hand market could be eating into new sales of some of those players.
Yes, so that seems to have been the case with Gucci, say, about a year ago. There was a lot of their sales that went into department stores and the grey channel and the second-hand channel, where they effectively dumped excess inventory. And that really put a lot of pressure, especially on the Gucci handbags, the leather goods. They seem to have come through most of those issues by now. So the volumes are still lower, the prices are still lower, but to your point, it wasn't quite as bad as people expected looking backwards, and the guidance they gave is slightly better than people expected. So a big relief, because it was in the price that things are very negative in the luxury goods sector. And Kering is the one with its Gucci brand that sort of got stuck between a premium brand but trying to increase volumes and therefore cutting prices to be in the high affluent market as well, to make it more affordable for upper middle class people to afford their products. So by being not premium enough for really high net worth individuals, and then cutting the price, and then not getting the volumes they wanted, they were stuck in no man's land. But they're on the path to recovery, and if they continue like this, there's a lot of catch up to do, because the shares are relatively cheap if you look back to where they were trading and the type of profitability they had 2 to 3 years ago.
And sticking with perhaps the theme around consumers' purchasing power, Coca-Cola also out with results today. The numbers were quite mixed, also showing that, consumers aren't spending as much as they would have on their favorite beverages. But what was quite interesting was the shifting consumer preferences, where we are seeing some volume growth when it comes to the more healthier beverages. Just your take on those numbers, Ricus.
Yeah, it came in below market expectations, and the one thing you don't want to have in the US during this quarterly earnings season is missing expectations in any form or fashion, because you're going to get hammered, as we've seen, not only with Coca-Cola but a number of other names. But yeah, I think there's a general trend towards less sugary and more healthy, and you can see it, whether it be Coca-Cola or Pepsi or any of the other drinks manufacturer. But I think on the day just now, it's basically your revenue and earnings not quite what the market wanted from the company. It's had a very good recovery run over the past 2 or 3 months, in line with other consumer defensive shares. You're just going to go and take a look at something like McDonald's, for example.
Yeah.
So it was just, as far as I'm concerned, just results not quite meeting expectations.
And that was going to be my next question then, JP, given, the recent volatility we have been seeing when it comes to those counters and whether it strengthens the case for defensive consumer stocks like Coca-Cola, like a McDonald's.
Well, if you look at the past year to 18 months, a lot of these so-called defensive stocks have not seen very good share price performance, because when everyone rushes into a defensive stock, the price rises to a point where it's not defensive anymore. There's actually a risk of a sharp downward move, because it's a company that generally, if it's in the consumer defensive sector, that doesn't grow its earnings at a very high rate. And when everyone pours into those shares, they become fragile, and that's when they take these steep downward moves when they even disappoint slightly. So just because a company is in a defensive sector in terms of selling food, doesn't always mean that the share is defensive, because it can become too expensive. And a lot of US food producers, consumer defensive type stocks have become too expensive, have seen those adjustments to their stock prices. And now you can say, for the first time in a while, the shares are almost as defensive as the businesses. So they're much more fairly valued today than a lot of these companies' shares were a year to 18 months ago.
Now, from a defensive sector to a more cyclical one, in commodities, BP also out with earnings today. 86% decline in annual net profit due to the lower oil price, as well as some impairments linked to, I think it's green strategy. The firm also suspending share buybacks. The market's not reacting positively to that, JP.
Most of these oil producers' stocks are quite bombed out, because the oil price has been sliding for a while. The sentiment is depressed. So again, to my earlier point, even though you come out as an oil services company or oil producer with negative results, earnings being sharply lower, it's already in the price. A lot of these cyclical companies are trading at levels where the share price is effectively defensive. So it's an upside down world where some cyclical companies are trading at defensive levels, and therefore they don't react to negative earnings releases. Well, some so-called defensive shares have seen sharp downward movements because their shares became too expensive. So the whole oil price sector is quite an interesting time, I would say, at the moment. If you look at where they're trading, because there's a lot of negativity priced in. So any uptick in the oil price, any positive operating leverage they could get from a higher oil price could really boost the shares of oil producers.
And I mean, we've seen it in a counter like Sasol as well here at home when there are shifts in the oil price. Ricus, I want to get your sense around what we are seeing when it comes to those BP earnings. I mean, BP also known for its significant share buyback programs as a method of returning capital to shareholders. Could this be a trend across the oil majors, considering where prices are currently at?
Well, I think first of all with BP, I just had a quick look. It's up 50% since May last year. So in line with other oil stocks, it's had a great recovery, and at the moment with what's happening in the Middle East with tensions rising there, it's giving some kind of support for oil price, specifically if you measure oil as a commodity versus other metals commodities or industrial commodities. It's lagged way behind. So in that sense, today's results, again, I wouldn't read too much in it, apart from, not that I follow BP all that closely, but I think, again, it's just results and expectations. But I think a lot of your oil companies at the moment, you've got to realize where those companies' reserves are. For example, gosh, I've forgotten its name now. But where are your reserves at the moment, and where's it going to be the easiest to to get out of.
There's been a lot of news flow out of Asia, Ricus, particularly around Japan, the Nikkei hitting record highs after Prime Minister Takaichi, that election victory over the weekend. And a viewer here interested in Japanese equity. Please advise on best stocks and also ETFs that you recommend. I'm not sure if it's a market you watch quite closely.
Not on the ETF side, but considering her mandate and the fact that she's got a supermajority, she's got to balance two disparate things. First of all, she wants to fiscally stimulate the economy, but then she's also sitting with a huge bond problem. So heaven knows how that's going to work out. But let's say she's successful. But considering her base, the obvious sector which springs to mind is the Japanese defense sector.
Okay. All right. What about you, JP, agreeing with Ricus there, seeing value within the Japanese defense sector?
Yes, a lot of Japanese stocks, and that's why the Nikkei is reaching new highs, have bounced really strongly and have done very well the last, say, 2 to 3 years, as they went from just about no inflation, even a little bit of deflation if you go to 2021, all of a sudden having low levels of inflation. So a lot of companies for the first time in something like 40 years increasing their prices, which is sort of unheard of in Japan and has had a bit of a shock on a lot of consumers that have been used to stable prices, if not prices getting cut every few years because of the deflation that took hold in Japan and the shrinking population. So where we are now is very different. With just that little bit of inflation, yes, defense is good because of what's happening in Ukraine. I also think the banking sector is still a lot of opportunity. To go from deflation to low inflation is extremely good for a bank's balance sheet.
Okay.
And you saw that with the big trading houses in Japan, which all of them have got a bank as part of their very diversified operations. They've all done well, but there could be more opportunity there. And then the semiconductor equipment manufacturers, the likes of Tokyo Electron, Advantest, they've also done very well. And if you look at the capex that's going to be spent by the Magnificent Seven, that opportunity seems to be continuing. I'll put SoftBank in there as well. SoftBank obviously owns a big chunk of ARM. So there's a lot of opportunity in Japan, but it has been a source of opportunity for, let's say, the last 3 years.
Okay.
And therefore, the opportunity is lower than what it was 3 years because the share prices have already risen a lot.
JP, I was reading a note by Goldman Sachs, and the analysts there are expecting an uptick in M&A activity here at home. And I'm wondering whether this is a genuine vote of confidence or more of a function of the commodity cycle doing the heavy lifting.
Yeah, it's an interesting one. So I think the major opportunity in M&A in South Africa is probably in the mining sector because a lot of mining companies are flush with cash because of the high commodity prices, especially in the precious metals part of the commodity sector. And their shareholders have been shouting at the management teams over the last number of years to say, please, don't put the money back into the ground by sinking more shafts. Give us the money back. And some of the management teams might say, well, maybe we'll buy some competitors. That's another use for the cash and grow our empire. So you might see some M&A in the commodity space. We obviously almost had Glencore Rio. We almost had BHP Billiton Anglo American. Now we're going to have Anglo Tech. So there might be some more opportunities in the commodity sector. In the banking sector, there was a flutter of excitement when we saw one bank hold shares in another bank, but that's nothing. The bank did clarify, that Standard Bank, that it's not strategic. It's just all of their subsidiaries are stakes taken together. But our banks do have excess cash. It's just that we already have 7 major banks, so difficult to see further consolidation. And then in the mid and small cap space, we haven't seen M&A, we haven't seen takeovers. It's more a case of the management teams buying out the businesses and delisting them.
Yeah.
There's been a lot of that happening in the mid-cap space. That could continue, but we will hopefully see some higher prices in the mid-caps, which will make it more difficult for the management teams to do leverage buyouts. That means less M&A activity, but better share price returns for minority shareholders who own these shares on the JSE.
Beyond what Ricus has highlighted there, Ricus, what other sectors where do you see more compelling M&A activity? I've seen a lot of deals within the property sector as well.
Yeah, possibly. I mean, we've had quite a nice little run in the property sector, but I think Jean Pierre's covered it very well, and I really don't have anything useful to add to that.
All right, let's stick with you then, Ricus. Pepkor CEO selling about R500,000 worth of Pepkor shares. Viewer asking whether this is anything to worry about. I feel like about a week ago we were talking about this, but we were talking about We Buy Cars founders selling some of their shares.
Yeah, I have spoken very recently about Pepkor, and I didn't think it was extraordinarily cheap or expensive at current prices, so I wouldn't read too much into it, from my side at least.
Okay. Anything to be concerned about, JP?
Not that I know of. Look, the individuals are never going to really say what they're going to do with the money. It could be that they need to pay tax. It could be that they had some gearing. They need to pay off some debt. It might be that they're building a house at the sea and they need some extra money because the building costs are above budget. It could be that they want to take a very nice holiday, go for a long cruise overseas, and they thought the rand would be stronger than where it is. So there's a lot of reasons why management teams and individuals might sell. There's usually only one reason why they would buy. So selling could be a negative flag, but I think what is more useful is usually seeing a big purchase as a positive sign. That's usually more useful than a selling sign being interpreted in a certain way.
Yeah, somewhat a vote of confidence. Let's move over to Quilter then. Just your thoughts around Quilter and whether you see value there. What is your long-term view? Yes, just found the question. What is your long-term view on Quilter, JP?
I'm not a big fan of the Quilter business. It's basically a platform business. It's all about the assets under administration on the platform and how well their advisors attract money to then pump that money through the platforms. So they have done well. The share price has done well. The business has done decently. They had a few issues with some IT systems that they tried and failed, and then needed to implement new ones. I do think if you look in the sector that there is possibility of some M&A here as well.
Okay.
One of the bigger players, the wealth managers, could look to buy Quilter and get access to that platform and the network of financial advisors. But it's quite reliant on those flows. So if markets take a leg lower, you'll have less assets on the platforms and less fees for Quilter. And therefore, it's not one of my most favorite businesses. So you can be involved because of possible M&A, but for the long term, I'm not very bullish on Quilter.
We just touched on We Buy Cars, and a question coming through, Ricus, just your thoughts around We Buy Cars. We have seen the share price taking a knock on the back of what I mentioned there around the founders selling some of their shares.
Yeah, and I think they've had negative press in the sense of not negative about the company, but the strain that market is undergoing as a result of the influx of more affordable Chinese model, etc., etc. So any company's share price is partly dependent on fundamentals, but it's also driven by sentiment, and sentiment towards that sector, and by default, We Buy Cars at the moment is poor. So I'm not looking at that as a potential buy at these levels until such time as people sort of forget about the current troubles that they might be experiencing in their business.
So margins under pressure at We Buy Cars when we saw those last numbers, JP. But they did say that, eventually as more and more Chinese vehicles get into the market, we will see it filter through to the second-hand market. And I guess I'm looking for your long-term view on We Buy Cars as that plays out in the longer term.
Exactly. So I think there's a transitional period where adjustments need to be made and margins will be under pressure. But over the long term, when we have got this equilibrium back and you've got the balance back between the price of new cars versus second-hand vehicles, I think the margins could revert close to where they were in the past. Maybe not quite there because the second-hand cars will be structurally cheaper, but they will be competitive with new cars. Well, at the moment, second-hand cars find it very difficult to be competitive with new Chinese cars because they're coming in at such an attractive price point. So after the transition, longer term, I would think that We Buy Cars gets back its very strong profit growth. And therefore, depending on your investment horizon, if you're a short-term trader, maybe you don't want to get involved right now. If you're a longer-term investor, I think We Buy Cars is still attractive.
All right, let's move over to the small mid-cap arena. A viewer asking for your analysis on the Purple Group, JP. I hold Purple Group as a growth stock, and it has delivered strong returns over the past year. I would appreciate your view on what levels of earnings per share growth would be required this year to justify a 38 PE ratio, and whether the company is likely to deliver that level of growth.
Sure. So I haven't looked at Purple close enough to give you a firm view about what the earnings could be.
Okay.
What I would say is if a company is trading at 38 times earnings, and those earnings are, call it normal earnings, then you would need very strong growth, probably 20% per annum plus for a number of years to justify that type of rating. So it could be justified, but you really need to see then the Philippine business grow very strongly. You need to see South Africa continue to grow. And you need to see them capture that growth in the number of clients and the value of all the client assets in their own revenue, in the fees that they charge. So it's a difficult one. They've got very good branding, very good name out there. But South Africa in global terms is very small when it comes to retail brokerage. So they really need to break into some international markets to justify the current price.
All right, Ricus, I'm going to give you a totally different question. The panel's view on Prosus, which continues on its correction or pullback. I am down 10% and my strategy of not falling in love with any shares comes into play. Should I hold? Should I wait?
Okay, let's just talk about what's happening with Prosus and Naspers at the moment. And the decline is mainly on the back of Tencent, and the decline in Tencent. Two things. The first and big thing is the Chinese government, as per usual, where there's a fear that Xi Jinping will put a tax on the services that the Tencent group of companies provide. In other words, the information services. That was the first to press, and secondly, they've had to withdraw their chatbot on their form of WhatsApp over the past few days, and that's ahead of the Chinese New Year, and that dropped the Tencent price another 4% or something like that. But the main thing at the moment is, are these service providers like Tencent going to be taxed on their earnings going forward, or increased tax on their earnings going forward?
All right. Let's move over to stock picks. Yeah. Let's move over to stock picks. I'll start with you, Ricus. Where are you seeing value this evening?
It's a company called Advanced Industrial Technologies. Just background. Freight rates in the US have increased by 8% over the past 12 months. That's huge. And it's not things being imported. It is freight in what's called the Rust Belt. In other words, that center of America where manufacturing has been in the doldrums for decades. It points to a revival, whether it be because of Trump's policies or despite Trump's policies. I'm not too sure, but it has a lot to do with the buildup of AI spend in that geography. If that is the case, applied industrial technology is perfectly placed, because what they do is provide services to, whether it be food processing plants, whether it be car manufacturers, for the automation, for the increased efficiency of, whether it be valves, or it's real industrial stuff, valves or robotics and whatever. They've had a steady dividend growth for the past 15 years. I like that kind of company. So it's boring, but it's tied to an industrial revival that we can already see happening. And transport is your canary in the coal mine, as far as I'm concerned, to underwrite that real revival.
What about you, JP? Also going offshore?
Indeed. So I'm choosing Microsoft. We spoke about defensive shares earlier. So Microsoft is as a defensive growth business as you can get. dominant, obviously, in operating systems, Azure growing very strongly, a bunch of other businesses as well. And the shares just got too expensive. So they dropped by just over 20% over the last 3 months, as people all of a sudden got concerned about Claude bot and vibe coding, and people thinking software maybe doesn't have as good a competitive position as they thought before. I do think that Microsoft is relatively safe. They've got a wide moat, a competitive advantage. People are not going to start coding their own Microsoft operating system. And I do think that Azure still has good growth ahead of it, notwithstanding the competition between OpenAI, Anthropic, Google with their different bots. Even if Copilot doesn't win out, I think Microsoft could become agent agnostic and offer whichever agent you want to use in Microsoft, not just Copilot, which uses OpenAI's bot or ChatGPT. So because of that defensive stance, but the share price being down over 20% over the last 3 months, I think there's an opportunity to pick up Microsoft at the current share price.
All right, gents, thank you so much for your time and joining us this evening. And that's all for Stockwatch today. Thank you to my guests, Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Up next, it's The Close.
Thank you.